You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Today, we are going to do a webinar on something that we've been talking about for a number of years now, something called Wealth Formula Banking. Now, this is effectively our version of something that is broadly known as infinite banking. And for a long time, I had no idea what it meant. I'd hear commercials about banking on yourself, and I'd be like, what does that mean? I have no idea what that means. And so I ignored it for a number of years. And one day, talking to one of our presenters today, Rod Zabriskie, just realized what it was. And it was like, aha, this is absolutely genius. Why didn't somebody tell me about that, years ago? And that's what I've found in general about these products. As I've written in my email, the high net worth folks, whether that's premium finance or these types of insurance policies, they use these policies. They are there for, if they are modeled correctly, they are there for the sophisticated high net worth professional. And if you look up the words life insurance retirement plan, you'll see that LIRP. That is a very common thing in the ultra high net worth space, and Wealth Formula Banking is one of those types of LIRPs. We again started talking about this several years ago, and then we just assumed people kind of knew what it was, and then in talking to Rod a couple of weeks ago, I was just realized that probably since we started talking, we've added several thousand people to our audience. And so we thought we would do a review on this very basic, but extremely powerful concept, which I will add this much is that I can't think of a single person I know who has, who's taken advantage of this kind of concept and been sorry about it. In fact, more often than not, it's one of those things that the longer that time that goes by, people are more and more satisfied with their decision to take advantage of some of these concepts. So without further ado, I am going to introduce you to two of my colleagues here, Rod Zabriskie, who I mentioned before, and Brennan McConnell. Guys, why don't you take it from here?
All right. Thanks so much, Buck. We're grateful to be here and glad for everybody joining, and those will be hearing this later. And we get really excited about this concept. And someone might say, well, man, that must be really cool. And I think it is. I really think it makes a huge difference. And so what we'll teach you today, I think will help you see how Wealth Formula Banking truly adds an additional layer of profitability to your investing. And to be clear, this doesn't replace the investing you're doing. It just works in conjunction with what you're doing. And hopefully that'll be clear as we go. So first thing I want to do is just kind of talk through what the value proposition here is. I mentioned this, doing the exact same investing, but producing a higher overall return. We refer to our opportunity fund as the place where we keep the money that we're going to be investing, right? So you build it up, and in most cases, people are doing this in a savings account, money market, and build it up, take it, invest it, create cash flow, flow that back, build it back up, and go out and invest in something else, right? Well, we'll talk about some of the inherent inefficiencies of doing that. But what if I told you could get a consistent, predictable 5+% return on those dollars while they're between deals? Well, that would be great, right? And what if I also told you that it is tax-free while it's there and while it's growing? So again, takes it to another layer. Depending on your tax bracket, it might be 7-8% equivalent return in a taxable place, right? And then in addition to that, you can leverage that to work for you in multiple places at the same time. So these are the keys that we're going to focus on during our time today. And so we talked about the whole kind of thing with the opportunity fund, right? What is your money doing when it's between deals? Well, you want to have it in a place where it's liquid. Of course, you're going to use it to invest, so it has to be available. You want to have it in a safe place. Some people might sometimes get desperate if it's sitting in their bank account. They're like, man, I got to get it working for me. Let's go put it in the market. But the problem with that is if the market goes down same time as opportunities are coming back around, well, that's a problem, right? Third, we want it to be growing for us. And that's probably the most glaring problem with the savings account money market. Right now, money markets are doing a little bit better, but 2 years, where were they? 1.5%. Unpredictable what you can expect on that. And then, of course, if you can have that growth with some tax benefits, all the better. And then being able to use it as leverage, create benefit in multiple places. Those are the things we would all love to have with our opportunity fund. And I'm here to tell you that you can get all of those things, because instead of using the savings or the money market, if you use wealth formula banking as that opportunity fund, then you can get all of these benefits. Okay. So before we get into any more detail, what I want to do is turn some time to Brennan. He's going to walk us through a quick case study so we can just see it's kind of some of these principles that I've been talking about in action.
Yeah, so we're going to talk a little bit about norm and prosperity and give you an idea of what this actually looks like in action. Norm is going to be using a typical opportunity fund, which is just going to be a savings account. He's going to build money up in that account and then deploy it once he's ready. He's got enough capital in his account. He'll deploy it into a cash flowing asset or investment. In this case study, we're using the investment yield of 16.5%. And some people will look at 16.5% and say, wow, I wouldn't do a deal if I didn't get at least 16.5%. And others might say, wow, that looks really great. I'd love to get 16.5%. So that's just, something we're using as the 16.5%. Prosperity, on the other hand, is going to get the same 16.5%, but she's using wealth formula banking in conjunction with her investments. So because she's using wealth formula banking as her opportunity fund, she's going to have an individual investment yield of 20.8%. So, getting into the actual numbers of what's happening, we're assuming that we're taking $104,000 as an initial investment. We're going to show the 7 years of cash flow coming off of the deal. And without depreciation, the pro forma net cash flow is $183,000, which is that 16.5% that Norm is going to get. When you add in wealth formula banking, you're going to see a $215,000 total return with an IRR of 20.8%. And then, of course, with most of the alternative assets that we'll be investing in, there is the depreciation that you can add to that. And so the pro forma net cash flow with depreciation.
And actually, I didn't drop those numbers in on this one.
Oh, got it.
But yeah, and I think higher. The point we were just leading to is that this works in conjunction with a lot of different principles that we're doing to make our investing more efficient. And so when you invest in real estate, when you invest in these things that create additional tax benefits, it just amplifies it. And so I'll throw the numbers out just because I didn't put them in here, but in this particular investment, when you add the depreciation, the 16.5 would turn into about 30. And then when you take that and you're using the wealth formula banking, that turns it up to like a 36, 37% return. And so when you take what already was a pretty good return, man, 16.5, especially in the last few years, a lot of people would feel really good about that. But you more than double it by adding these additional benefits, wealth formula banking being one of them, then these are the ways that, like Buck said, the wealthy become more wealthy. They just make the most of the dollars that they have and that they are using, that they were going to invest anyway, but just by flowing it like this, it works out a lot better.
Just to be clear, I think the point of that, although it got a little bit confusing, is same money out of your pocket, right? Same money. And in one example, the only difference is that money flowed through this wealth formula banking vehicle. The other one did not. And the one that flowed through the vehicle created more money. And that's the kind of thing that you just look at and, oh, that makes sense. Why would I not do that? Right. And those are the kind of the aha things that I'm talking about, which is, all you're doing in that scenario is you're using, you're basically borrowing from yourself. But you're not really borrowing from yourself. You're borrowing from a insurance company's ledger. And by simply doing that, you're adding just a little bit more leverage, extremely safe leverage, because, again, it is from an insurance company. But in doing that, just by the flow of that money going into this thing and then into your investment, instead of directly into the investment, you added several $1,000s to your overall return. And that's what I was getting at, where you're just sort of like, oh, why wouldn't I do that? So anyway, guys, sorry to interrupt.
Perfect. No, that's great.
So let's talk a little bit more about what the vehicle is. And, Buck already mentioned this a little bit, but what we're talking about is a max overfunded dividend paying whole life insurance policy, or what we like to refer to it as is wealth formula banking. And wealth formula banking, the way that you look at the insurance policy, what's actually happening, if we're not talking about any outside investments, let's just look at the actual vehicle. You're going to see a net 5% plus return in the policy while your money's sitting there in between deals. In addition to that, Rod mentioned that you're going to get tax benefits, right? Your money's growing for you tax-free. You access that money tax-free, whether it's for investing in different deals or as income. And then in addition to that, we also get a very safe and predictable place that we can keep our capital, which is essential for any opportunity fund. It's got to be safe, predictable. These insurance companies have been doing this for 100 plus years. And then on top of that, any opportunity fund has got to be liquid. You've got to have access to that capital to deploy when those deals come across your desk. So it's extremely important to have that liquid benefit to it. And then because it's an insurance policy, there's going to be a death benefit on that. And the way that we structure these policies, strategically, we're decreasing the death benefit as best we can according to the IRS limits that they've set. But regardless, there's still going to be a death benefit, which most of our clients view the death benefit as death benefit they don't have to pay for in any other way, or just an added benefit to using the strategy. And then finally, the loan provision, the ability to take loans on the policy is actually a very great benefit. And we'll talk a little bit more about the loan provision, but that's how we're going to get our dollars working for us in two different places at the same time.
Perfect. And next, what I want to do is just walk us through the flow. Okay, so we've kind of thrown out some principles, some benefits that we're aiming for. Now let's talk about how we do that. So the first thing is we set up this policy, this max overfunded high cash value policy. We start putting money into it, create that 5% tax-free return. There's even some asset protection that comes with that on a state-by-state kind of rules basis. That can be very valuable in terms of having that protection. And so now the money is there. Now we're out and going to find our investment opportunities. And when we do find something we want to invest in, we're going to use the funds from the wealth formula banking policy to do that. But I'm actually not going to take my money out of the account. I'm going to take a loan against the cash value that I have in the policy. So in other words, what happened is by putting the money in there, I've created an asset. And because the asset is there, the insurance company makes available to me a loan using the cash value as collateral. So the money, my money stays there in my account and continues to grow on a compounding basis. But now I've leveraged against that to go out and use that loaned money to invest in whatever I want. It's completely up to me onto how I do that. So then when I do that and I'm creating cash flow and other returns coming back to me, I'll flow that back towards the plan. Technically, I'm paying down the loan in doing this. More importantly, I think of that as replenishing my opportunity fund, because I'm going to build that back up and then go out, take another loan, go invest in something else. And we'll get into a little more detail on this in a minute. But one of the efficiencies that we create on this is as I'm paying that back, I am paying interest on the loan, but I pay simple interest on that loan while simultaneously what I have in my account continues to grow on a compounding basis. And that becomes a really powerful arbitrage that creates additional layer of value for this. But I flowed that money back, I replenished it, I go out and find more investment opportunities, I repeat it, and I just keep working through this cycle where I've said it, I'll probably say it a few more times, I'm continuing to invest in the same things as I was investing in, as I would invest in anyway. I'm just flowing it differently by doing it through the policy instead of through my savings account.
So let's talk a little bit about how the strategy actually works and what's happening inside the insurance policy. So the way that it works is when we create a wealth formula banking policy, we capitalize that policy by paying, funding the premium into the policy. When we do that, the insurance policy is going to grow in two different ways. The first way that it grows is the guaranteed interest, which is a contractual guarantee. It's going to happen every single year, something that you can count on, and it doesn't vary. And that's going to be anywhere from 2 to 3.75%, depending on the insurance company we use. And then on top of the guaranteed interest, because we're working with mutual life insurance companies, you also get a dividend, which is the dividend is just as the company profits every year, you're going to get a part of that profit as a dividend. And the dividend will range anywhere from 2 to 3%. So you get the guaranteed interest plus the dividend. And that's how the actual whole life policy is growing year in and year out.
I might just like to point out one thing, which is, they say, well, 2 or 3% guaranteed. How guaranteed are we talking? And this is where, the strength of the companies come in. You want to talk about, how old these companies are, and essentially you're not really missing dividend payments for, I don't know what, 100 years plus.
Yeah, that's a great point. Yeah, these companies that we're working with, we only work with A-rated companies. They have to have been around at least 100 years. They've got to be mutual insurance companies, and they have to be consistent in paying those dividends. So to Buck's point, even though the dividend's not guaranteed, they have been paying this dividend, most of them for actually over 150 years consistently through, any financial environment, Great Depression, high interest rates, COVID, through all of that, they've consistently paid a dividend, and they've really never missed.
And by the way, that's one of the reasons why, I don't know if some people have, maybe grandparents that were old enough back in the day where they lived through the Depression. A lot of those people were huge fans of permanent life insurance for exactly this reason, because when everything else went to hell, they still had their permanent life insurance that continued to pay out. But anyway, that's just an added bonus is knowing that you have this kind of, this kind of product, but who's behind it. And then you look and it's like companies that are basically stronger than the banks.
Yeah, absolutely. And Buck alluded to this a little bit, earlier in the webinar, but what's happening here is when we create a policy, the wealth formula banking policy, that's going to give us access to a much larger bucket of money, which is the general account of the insurance company. And so what happens is we fund our dollars into the wealth formula banking policy. Because we have that, we have access to this general account. That's where we're going to be taking the loan from. So when we request a loan, it comes from the general account of the insurance company. We take that loan and invest that into a cash flow investment, any alternative asset that you're used to investing in. We want to just continue to invest in those things that we like. And then as the cash flow comes off those deals, we're going to funnel the dollars back into the insurance policy to, again, replenish our opportunity fund so that we can repeat this process over and over again. Now, the cool thing is there's a divider between our insurance policy and the general account of the insurance company, which really all that means is that we are going to continue earning compounding interest in our policy. Even when we take a loan, it's as if those dollars never left our policy. We'll continue earning that 5-6% inside of our policy, in addition to being able to use those dollars in a cash flowing investment.
And one of the powerful things about this is that I can go and invest it in whatever I want, and the payment of the loan going back is also completely up to me. Because in other words, by what Brendan just described, where I have that cash value sitting there, it's in an account with the insurance company, growing, collateralizing this loan. And because of that, it's completely up to me to decide how I pay that back. So the thing that makes the most sense to me is based on the way that my investment cash flows, right? So if it's a monthly distribution, then I'm going to take that. I'm going to flow it back on a monthly basis. If it's quarterly or if it's once a year, then I'll pay it that way. Even if it's something where I'm investing in something, maybe it isn't as cash flow heavy, but there's a large lump sum later. The point is that I'm just going to build my payback around the investment itself, which makes sense, right? Again, that's what I'm doing now, as I'm flowing money back to my savings account instead of in this case, I'm just flowing it through this plan.
I don't know if you're going to mention sort of the arbitrage too, Rod, in terms of, or should I? This is a good time.
You can, go ahead and jump in, lead us.
Yeah. I mean,
that's actually the next thing.
One of the things that I think is really important, and that again is sort of one of these aha moments for me to understand how this all worked, is that, so basically think about, you've got this money and it's clipping around, what is it now? About 5%, so 6%, something like that, which in and of itself is not huge, but it's, it's better than what you're getting in a savings account by far. Right. So it's good. Now, so if you think about that, that's going to continue to grow. When you borrow money when you're borrowing money, you're not actually borrowing money out of your account. You're borrowing money from the insurance company itself, off their general ledger. And what's important here is that your money is growing at this compound rate. So, if you go back and you look at any image that shows simple interest versus compound interest is, it just picks up and then you get a lot more money. Well, so your money's growing at a compound rate, and then you're borrowing at this simple interest rate, right? And the simple interest rate is what you're borrowing from the general ledger of the insurance company. And that's effectively allowing you to just borrow insurance money while your own money continues to grow at a compound rate. So that's why I call this, making money in two places at the same time, with the same money, because you've got that money clipping along at 5% compounding, and then you're borrowing money from the insurance company off of their ledger at a simple interest rate, and then you're deploying that into something else. And so that's, to me, one of the big keys in understanding why it is that if you simply put this money into one of these vehicles and then invest it, you'll make more money than if you just do it directly from a savings account, because effectively it's just adding a second investment for you. That's all it's doing. It's just investing and then investing again using the same money. So hopefully that's clear. Maybe, Rod, you can say it that others understand it.
I appreciate you throwing that out there. And this is one of the differentiation points. You mentioned infinite banking and Bank on Yourself a little earlier. And if any of you have, seen any of those programs, one of the things they focus on is using money to go on vacation or buy a car or kind of consumer types of things. But with Wealth Formula Banking, we are hyper focused on using this for investing. In other words, using it in a place where I'm able to create value, because I can create this arbitrage here, but I can't do that in the infinite banking if I'm just spending the money and trying to capture some sort of arbitrage with the interest rates, which may or may not actually happen, right? In this case, it could be the exact same interest rate, and I'll show an example here where it is, and I'll still come out with a lot more money in my account, a lot more growth in the interest on my account versus interest that I'm paying. So let's actually jump in on that. In this example, what I'm saying is I put money in my account, and I'm going to take $100,000 loan against my policy to go out and invest in something. And in this particular case, that'll create an amortized payback over the next 20 years. So I'm paying $8,000 a year towards this payment. Over time, as I pay that down, I'll end up paying a total of about $60,000 in interest. Okay. At the same time, I have $100,000 sitting in my account that's growing. Okay. I used a 5% interest rate on the previous slide. I'm going to use 5% on this one. Okay. So even if the exact same interest rate, in this case, now I'm earning 5%, but I'm earning it on a compound basis. So when you fast forward to the end of 20 years, in this case, I will have earned in interest only, right? So my total balance is $265 at the end of the day, but I earned $165,000 of interest during that same 20-year period. So when you say, well, I earned $165, but I paid $60, I that arbitrage created a difference of $105,000 for me. That's additional value that I have in my pocket, or more appropriately, in my next investments. I'm buying bigger investments down the road because of all this value that I'm able to create along the way. Okay, so let's look at another case study here, and in this case, it's going to be a little more, little longer time frame that we're going to talk through here. And what I'm going to assume is that I'm setting aside $100,000 a year for 5 years, so 500,000 total going in to capitalize my opportunity fund. But I don't have to wait for the end of the 5 years to start investing. When the first 100,000 goes in, I'm going to immediately start investing. Initially, put that into a syndication, and then as I cash flow that all back, I'm capturing those dollars, replenishing the opportunity fund, so I can go back out. And subsequently, we're going to go out and buy some real estate cash flowing assets of our own. And when I do that, what I'm going to do is I'm going to get an 80% loan from a traditional lender. That 20% down that I'm putting in there is coming from the wealth formula banking policy, right? So I take that loan, that's my 20%. I get 80 from the traditional lender. And then for our assumption on this, we're going to assume a 15% cash flow from the investment with a 5% appreciation on the properties. And here again, like Brendan said earlier, we're not necessarily making any statement about what you should be earning in your investments or whatever. But to apply it equally across both sides, apples to apples comparison, we're going to use these numbers for our example. Okay, so here's the comparison. A lot of numbers, so let's kind of talk through it. That first 100,000 goes in, and I'm ready to go out and invest in that syndication. And you're probably noticing that on the wealth formula banking side, I have 74,000 to invest, whereas on the savings account I have the 100, right? So we're totally owning the fact that there are costs, and they're a little bit more front end loaded. My costs aren't as high when I put the second, third, fourth installment in as much as the first. But the point is that I'm taking that, I'm investing it, creating that cash flow. But you'll notice as I do that, as I create that cash flow, as I capture that growth, and then I go out and invest in another, the real estate property in year 5, and then again in year 10. And as time goes on, all of a sudden I'm in a place where I'm able to buy larger properties. In other words, I have all this benefit working for me that we've been talking about on the wealth formula banking side, so that I create more on that side to the tune of, by the end of the 20 years, I have about $2 million of additional value from my investments that by using wealth formula banking versus the savings account. And I'm not saying that the policy is doing all the work. Really, the real estate, the alternative investments that we all know and love, is doing the majority of the work. But the point is that by creating this additional layer of value for this same investments, I can end up at the end of the 20 years with $22 million of value as opposed to 20. And who wouldn't want that, right? Okay, so with that, let me just recap a little bit here. So the key takeaways is do the exact same investing, produce a higher overall return, produce a 5% plus return that's tax-free on the opportunity fund, and then leverage that money to work for you in multiple places at the same time to do that investing.
So if you're interested in learning more, there's a couple things. You can certainly just go to wealthformulabanking.com. And that is where, you can actually watch some more of this kind of these educational webinars if you want. Also, Rod, do you have a direct reach out email?
Yeah, Rod at wealthformulabanking.com, and you can catch me there. But yeah, we have a form you can fill out on that wealthformulabanking.com website as well. And that'll get you in touch with us to set something up.
The other thing I'll point out is if there are other concepts, which we will talk about at another time. And some of those might appeal to different kinds of people. We also have something that we've been interested in. I personally have been very interested in, called Wealth Accelerator, which basically relies more on what the stock market's doing. I don't have a lot of investments in the stock market, and that's actually one of the reasons why I actually like that, is it gives me some exposure to the stock market. But you can learn about that, and we'll probably come back and do another one of these explicitly on Wealth Accelerator as well. But you can go to Wealth Formula Banking and watch that as well, and you could do sort of a compare and contrast and see if either there's a number of people who do both of these concepts. Might appeal to you, the other might appeal to you, both or neither. So I think at the very least, it makes sense to go and, at least learn about these things because they're very common in the ultra high net worth space. And, there's a lot of things that we didn't really talk about, which is, some of the benefits from an asset protection side and estate planning, which is a huge thing, on the ultra high net worth side, using these vehicles for estate planning, that Rod and Brennan can do a much deeper dive on a one-on-one consult. So those consults, you guys can book those with Rod at wealthformulabanking.com or go to wealthformulabanking.com and hit and fill out one of those forms. But in the meantime, thanks everybody for joining. Thanks, Rod, Brennan, and
thanks, Bud.
See you next time.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.